Good afternoon, ladies and gentlemen. Thank you for joining in the 8 sessions of Start Your Own Practice and Practice Management. We have arranged a seminar series, webinar series to for the members who are looking forward to start your own practice and also to enhance and upgrade the knowledge of existing practitioners in various aspect of practices and the practice management. So we are here now for the 8 sessions. We have successfully concluded 7 sessions with over 200 participants for each session. We are here to talk about the valuation practice. So we see interesting topic, which valuation in the present scenario or present with the present crisis or with present economic conditions, valuation has been very challenging with various, particularly the assumptions, estimate to be used on the valuation and including the methodology as well. If you look at the valuations, valuation is used for various purposes, for maybe for tax and for particularly for sale and purchase transactions, and also a lot of financial reporting purpose. As you know that for various accounting standards requires financial fair value of particular transactions or asset to be determined based on the fair value. So that valuation is used for various transactions, particularly on sale and purchase agreements. As you sale and purchase transactions, the seller is trying to get the best price and the buyer is trying to get the fair price. So we as a practitioner has to determine, provide a right and appropriate valuation methodology and right value or recommended value range for the particular client or engaging party for their decision-making purpose. So one of the key decision to be made is basically selecting right valuation method, because each valuation method can derive different valuations value. And also one of the challenges would be basically is about using the assumptions, judgments, and some of the estimates as well. So particularly on the discount rate or the business in certain adjustments that are required to wherever the right value. So a lot of judgments used on the valuations. So a lot of experience is required, and and the valuation can also be challenging, particularly because you are recommending a value and you're giving a range of value to a client, and he may take a decision. So for example, if you're doing a value for a business restructuring purpose, we have to understand it's not, even though the majority shareholder is engaging you, and there's a minority shareholder who also may get affected. So you had to basically look in the interest of a majority shareholder as well as the minority shareholder as well. Like that, and it can certainly the valuation can lead to even legal issues or the reputation issues as well. So deciding the right valuation method and providing the right valuations value is extremely important as part of our own practice. So to talk a lot more about valuation services, we are very good speaker, very eminent speaker. That is Mr. Nishan Fernando. We all know about him. He is a past president of CA Sri Lanka. Mr. Nishan Fernando is the current chair of Asia ASEAN Group Standard Setters Group, which is the first Sri Lankan to hold that position. It's a significant achievement as far as our country concerned. He holds in Sri Lanka as in the position of managing director of BDO Consulting Private Limited, and also he's the chairman of First Capital Holding PLC. And he is the past president, and he has also served played a very key role in adopting IFRS in Sri Lanka in 2012 as a chairman of Accounting Standards Committee of CA Sri Lanka during the period from 2009 to 2013. He presently chairs the IFRS Implementation and Interpretation Committee of CA Sri Lanka while serving as a member of Accounting Standards Committee. He also held various other positions, including Accounting Standards Committee of South Asia Federation of Accountants and member of Accounting Education Board of IFAC, and also a member consultative advisory board of IFAC, a member Securities Exchange Commission of CA Sri Lanka, also member Security Exchange Commission of Sri Lanka, and also a member of /MB as well. So he is involved in a lot on the advisory services as a managing director of BDO Consulting Private Limited. So he has number of years of experience in valuation practices in conducting the valuations for various clients. So I now invite Mr. Nishan Fernando to deliver his speech, and also I invite all of you to raise your questions and clarification on the questions and answers, so that end of the presentation, so I can take up those questions and direct them to Mr. Nishan Fernando. So over to you, Mr. Nishan Fernando.
Thank you very much, Chamara. Good afternoon to all of you. Thank you very much for the kind introduction. And also now I am a bit confused. What am I going to speak? Because Chamara summarized the whole thing on valuation practice, what a valuation is and why valuations are being done, and what needs to be done and what are the critical areas. Anyway, please permit me to switch off the video in order to have a better connectivity, which I will switch on at the end of the presentation. Right, so today I hope all of you can hear me. So today
we can hear you.
Yeah. So today our topic is to discuss few things about practice management in relation to valuations. I'm trying to move the slide. Right, okay. So when it comes to valuations, we might need to do valuations for various purposes. The areas or the purposes which are very close to us, very familiar to us, are financial reporting and audit. Now, when you take financial reporting, for example, you need to perform valuations with regard to impairment. So entity CFOs, sometimes they do it themselves or they outsource it to someone else, a practicing firm, to perform the valuation. And particularly with regard to impairment, one may have to value intangibles if they are on the balance sheet, and also compute value in use in respect of certain tangibles and cash generating units. So if there are intangibles, we know that according to financial reporting standards, that every year intangibles have to be tested for impairment. So in testing for impairment, these intangibles, we need to look at a valuation of these intangibles. Then on the other hand, tangible assets, as you know, if they meet any of the triggers suggesting an impairment, then a value in use computation may be necessary to see whether actually the asset has been impaired, and you need to carry out a valuation. Then on the other hand, it may be necessary to determine fair values of certain assets in your balance sheet. For example, if you have financial instruments, those financial instruments may be equity instruments, may be debt instruments, you may have to perform a valuation. And sometimes if the entity has adopted fair valuation of liabilities, the provisions given in the standard, then the liabilities also may have to be fair value. And also certain liabilities like actuarial valuation of retirement benefits also need to be valued, but more often than not, these retirement benefit valuations are generally outsourced to an actuary. But I must say that according to the new standard or the IFRS, it need not be done by an external party or an independent party. You CFOs or accountants in the entity even can do the liability valuation, provided you know how to do it. Then secondly, as an auditor, you may have to perform certain calculations using valuation principles. You as the auditor will have to review the impairment calculations and impairment assessments done by the company. So as the auditor, you may have to perform that valuation, apply valuation principles and perform certain calculations and review those impairment calculations. And also those fair value assessments, what I spoke of a few minutes ago, also need to be reviewed so that certain valuation principles need to be applied. So as Mr. Chamara Aberatna mentioned at the beginning, your valuations always need to apply certain assumptions, and valuations need to exercise judgments and various principles, most appropriate valuation technique, and so on, so that as an auditor also, you will have to be aware of these valuation principles. However, in performing these valuations in the capacity of auditor, you may have to comply with certain requirements because sometimes it might create a conflict of interest in relation to a self-review threat. I will come back to it a little later. So those two are probably very frequent, these impairment calculations, fair value calculations for balance sheet reporting, and review of those in the capacity of an auditor are fairly frequent. Every year you may have to do that. And we are familiar with them. Only thing, as an auditor, as a preparer, generally you don't like impairment write-downs. So therefore, you need to, see how you do these computations and so on. Then the second part of it, apart from financial reporting or apart from audits, the valuations takes place, and it is a very critical ingredient when it comes to market transactions. Or it would be very critical in relation to certain restructuring arrangements within a large group of companies, and also maybe in relation to private transactions where the parents want to transfer their shareholdings in a company to their children. So in those situations also, the values may be required for either tax purposes or various other purposes. So the areas where you will need this when you are doing a share swap, maybe share transfers, amalgamations. These days, I mean, a lot of amalgamations are taking place as part of restructuring of larger groups. And also when you acquire a business and on the other hand, you dispose a business, for the buyer, it would be an acquisition, and the seller, it would be a disposal. So Chamara spoke about SPAs, sale and purchase arrangements. So there you need valuations. Then if there are mergers and if there are amalgamations. So now when it comes to these valuations, we need to apply the most appropriate method in order to arrive at the value. However, when it comes to primary methodologies, we have three broad groups of methodologies. I would actually like to concise this into two methodologies. I will explain why. The first is the valuation methodologies based on the principle of present value of future cash flows. So basically, in very simple terms, this is the best method in assessing the value of an entity, of an enterprise. But there are so many challenges because of various assumptions that you have to make and various judgments that you have to exercise. The second category is valuations or the valuation methods which uses multiples. You know that common valuation principles which uses multiples are earnings multiples, price to book multiples, and EBITDA multiples, EBIT multiples, and so on. But if you really look at these multiple based methods in detail, you will find those multiple based methods are finally very strongly linked to DCF. I will give you one example. If you take, for example, earnings multiples, what is earnings multiple? It is earnings per share. So earnings per share is derived from the profit. And one major adjustments between the profit and the cash flow is depreciation. Apart from that, there may be few other non-cash items that you might adjust, but depreciation is the main item which creates a difference between the cash flow and the profit or the earnings. Okay, we'll come to that later. Now, if you take the multiple to earnings, the multiple that we apply is the price earnings ratio. So what is price earnings ratio? Price earnings ratio is, of course, of a peer company. It is the market value divided by earnings per share. When you take price earnings ratio, market value divided by earnings per share, it is the reciprocal of earnings yield. because earnings per share divided by market value is the earnings yield. Then on the other hand, what is earnings yield? Ultimately, earnings yield is the yield that an investor would desire to have by making an investment in an equity instrument, which ultimately boils down to cost of equity. So which means, in other words, the multiple is cost of equity. So in DCF, the discounted cash flow, if you take, when you say discounted cash flow, we normally take free cash flows either to firm or to equity. So when you take free cash flows to equity and then discount by using cost of equity, which is very much similar to taking earnings and applying price to earnings ratio, or which is the reciprocal of earnings yield, or finally cost of equity. So therefore, okay, then it comes to the difference between earnings figure and the free cash flow. You know, in calculating free cash flows, we have to, after finally arriving at the cash flow, we need to deduct, we need to make a provision for the maintenance of the capital assets. So generally, we assume, unless it is very complicated, we assume that, okay, depreciation is equal to this capital cost of maintaining the capital assets. So you can see the earnings and free cash flows are more or less similar. The discounting factor we are taking is more or less similar. So which means finally, the earnings multiple method also is going to be very close to the DCF method. Same thing can be proved mathematically for price to book value multiple and for other multiple based methods also. So therefore, even though these methodologies are considered in two different categories in most of the textbooks, when you study deeper into it, all these methods are more or less revolving around discounted cash flows. So therefore, it finally is one group, and whether you consider it as one group or two groups, it doesn't matter. But finally, your values that you arrive from DCF and from multiples cannot have a significant difference. Of course, it won't be equal to the last rupee, but the difference has to be within an acceptable range. So by any chance, if your multiple based calculation is significantly different from your DCF calculation, you need to investigate why it is happening so. Now that requires a great amount of analytical skills. Then we come to the asset-based methodologies. Of course, asset-based methodologies is different from DCF. When it comes to asset-based methodologies, all what we do is we take the balance sheet and we take the assets and liabilities of that balance sheet and take the net asset value. Of course, we go through the assets and liabilities very carefully and see whether we need to make any adjustments. If the assets have not been revalued, then we may have to revalue the assets. And if the liabilities require certain adjustments, we might have to do that. Certain current assets, say receivables, for examples, need an adjustment for uncollectability. We may have to do that. We may have to adjust it. So likewise, we do a calculation adjusting assets and liabilities to arrive at the net assets value. Now, when it comes to the net asset value, now generally what happens is your DCF value is going to be quite higher, in most cases, higher than assets. However, this is also should not be the case. However, if the enterprise has a good brand which is not reflected in the balance sheet, that may be justified. Because in the net asset value, the brand is not reflected, but in your DCF, you are deriving those cash flows in the future using your tangible assets as well as your intangible brand. And therefore, your DCF value would be significantly higher than the net asset value. So you have to look at the difference and see whether this difference is coming because of a brand. Then if it is a brand, and if you still need the further comfort, there are further methods in which you can value the brand separately and see whether that difference is justified. Otherwise, even your net asset value cannot be largely different compared to your DCF value. Now, these days, when you do certain valuations of certain types of industries, in entities in certain industries, sometimes you find your DCF value is lower than the net asset value. Net asset value is higher. Of course, you can see this situation in the stock market. Market value of certain shares are less than the net asset value and the PBV is less than 1. What does it really mean? That is, the market value is less than the assets because those assets are not giving the desired level of return. Nowadays, you can see the return on treasury bills is 20%. And if the company is not generating a return on equity in excess of 20% or matching 20%, then their assets won't worth what is being reflected in the balance sheet. So that is why it is trading at a lower value. So that might require an impairment. However, there are so many other things to be looked at to see whether there is an impairment. But what I'm going to stress here is that even when you take the net asset value, there cannot be significant differences between the value that you derive from one method as against another method. Okay. So what do you need? Now, if you are going to do a practice on valuation, you need certain skills and knowledge, as I told you. And the most important of them is common sense. Common sense is extremely important if you are going to specialize in valuations. Then comes analytical skills. I mentioned about analytical skills because you need to have a good analytical mind which should go deeper into your calculations and identifying the elements of your calculations and comparing two methods to see which elements are not matching, which elements are giving rise to a significant difference between these two methods. Then you should have the skills of model building. Now this analyzing different methods, the values derived from different methods is fairly convenient if you have a model which goes into details. For example, if you are valuing a hotel, you need to forecast your revenue. So when you are forecasting revenue, now the easy route is to look at, of course, for hotels, this may not be applicable, but for an entity, I mean, what you would look at is basically look at the last year and increase the last year revenue by 10%, 20%, 30%, whatever you like. Okay. But model building is not that. Okay. If you want to forecast your revenue, you first take, okay, how many rooms that this company, hotel has. Then what are the categories of rooms? You know that these hotels have deluxe rooms, superior rooms. Even though different names are there, it is at the end of the day, it is the same room that is being given, maybe with slight differences, because one who goes to the deluxe room will not go to the superior room and check what are the differences. So therefore, even if the same room is given, you don't know. Okay, then suite room and this room, that room. So, okay, what are the categories? Based on which you can have a price differentiation. Okay, for each room, what is the price per night? Okay, whether that holds for the entire year or in different months, is it going to be different? So you build that also into the model. Then how do you get reservations? Because you know that you do certain reservations through credit card promotions where you have to pay certain commissions out. Okay, so you have to build in that. So then the net revenue will depend on how many rooms that you sell based on the credit card promotion, how many rooms that you sell based on normal marketing, how many rooms that you sell maybe through agents, and so on. So there are so many categories. So you need to have maybe 2-dimensional, 3-dimensional matrices in order to incorporate all these variables and establish a model to calculate revenue. So then it is easier for you to look at, okay, if you change these variables, how the revenue is going to change. So likewise, off-season, season, what is the occupancy rates? What is your occupancy rate for different categories of rooms? Right? So there are so many variables that are coming in, and each variable you have to build in to the model in forecasting your revenue. So it is not a matter of just taking the last year's reported revenue and multiplying it by 10%. Then you will have to see, okay, you have built in all that. Now, whether that matches with the strategy of the company. You have built in, okay, we are going to do some promotions during off-season using credit card promotions. Then that has to come only into the off-season, only for those months, or into a certain types of rooms. So it has to come only, that variable needs to affect only that category. So likewise, you should be able to build this model. I am still talking about revenue. And there are so many other things that you need to forecast in order to arrive at the final cash flow figure, right? So therefore, you need to have a very strong sense of model building, probably using Excel, that is the most widely used computer software program. So Excel model building is a very important requirement. Forecasting techniques, regression analysis, time series analysis, whatever you have learned in your statistics. So those certain analysis is required. And compounding and discounting. When you are given a rate of return or an interest rate, how do you compound? What are the effects of compounding? It could be annual compounding, monthly compounding, quarterly compounding, right? So this is very important when it comes to a valuation of a debt instrument, because in a debt instrument, you may have interest payments on a quarterly basis, monthly basis, likewise at different intervals. So you need to know exactly how compounding and discounting would apply. So those are some of the skills and knowledge components that you need to have. What are the challenges? Okay. One challenge is wider competition. Now, as you know, only a chartered accountant can do an audit, at least for a public company. That is secured by the Companies Act. But valuations can be done by anybody. So valuations can be done by audit firms. Valuations can be done by firms affiliated to audit firms or network firms. And in addition to that, you don't need a chartered accountant to do a valuation. A CIMA member can do a valuation. He can register a company called, let's say, ABC and Company, and he can start a valuation practice. There's no regulation on doing valuations for whatever the purpose. Even an independent valuation that is required to be done, which is required by SEC to be done in respect of mandatory offers and to be done in respect of IPOs, even those need not be done by chartered accountants. Anybody can do it. So there are a lot of competitors. There are investment banks who can do it. There are other firms that can do it. And audit firms are one of them. So therefore, because of this wider competition, if you are starting a valuation practice, then you need to have means of sustaining it, because it's going to be difficult initially. So therefore, having another audit and or accounting or tax practice on top of that, if you start a valuation practice, that would be the ideal, because you have a client base. So when those clients need valuation assistance, you can always step in and advise them, right? But of course, be mindful, the last point, you may fall into a conflict of interest situation. Now, when you are doing a valuation, the one most important question that you have to ask, provided you are running an audit practice also, whether your valuation is going to appear in a balance sheet which you will be auditing. So if the valuation result which you are performing is going to end up in a balance sheet which you will audit, then you will have a self-review threat. In that case, you have to either forget about the audit or forget about the valuation assignment. Then the other challenge is client pressure. Now clients, now you build a good model incorporating all variables and everything and go and make a presentation to the client. Now client has something in mind, the final result. This is the value that I want. And he asks you, okay, now you have, let us say this is a seller, right? So seller has something in mind. I want a value of 2.5 billion. You have gone with a model which throws out 1.5 billion. Now your client says, okay, you have put room rates of say, okay, $100, $150, and $200 for the different categories. Increase it to 150, 200, and 250. Right? So you increase, now 1.5 billion now increases to 2 billion. Then he will say, oh, all right, you have taken occupancy rates as 60%, increase it to 75%. Occupancy increased to 75%, and now you get a value of 2.5 billion. Now the client will say, okay, work out your valuation based on that. Now you find that none of the hotels in that particular area, say you have analyzed 10 hotels, none of those hotels in that area in the last 5 years have achieved a 75% occupancy right throughout the year. But now you are being asked to put 75%. You will find that none of those hotels in that area during the off season has hit $150, $200, and $250. But your client wants you to take those numbers. So what are you going to do? Now that is where you need to ask the client, okay, what are your strategies? In this particular area, no hotel is selling a room at this rate. So what is your strategy to sell this room, sell this at this rate? So he might say so many things. So you have to find ways and means of now loading the responsibility for those assumptions on the client. Otherwise, you will be in trouble. Right? So this client pressure is a huge challenge. Then what is the appropriate method? Now, like I said, whatever method you use, the resulting values should not be quite apart. It should be in a kind of a acceptable range. But your client might say, okay, I have got my property valued by an independent valuer. You know how independent valuers work these days. So based on that, the net asset value is huge. And you are asked, don't look at any other method, do a net asset value method. There may be certain instances, net asset value would be the appropriate method. But if you are a seller of your business, and if the business is not yielding sufficient ROE, you might give a valuation report saying, okay, this property or the company values so much, but nobody will buy it. So you need to persuade the client. You need a lot of persuasion skills there. and appropriate assumptions, we discussed this. However, don't forget the fact that in certain instances, your client might have specific strategies. Your client might say, okay, I am going to achieve these numbers by tying up with a foreign travel agent. He will supply me continuous traffic. All right, so that is acceptable, this thing, but however, it is not your submission, it is your client's submission. Put it in your valuation report under assumptions and probably support it with a sensitivity analysis also. All right, so I think now it is 4:15. Yeah, so we can, so that is a very short presentation. So I have not gone into many technical things. And Chamara, over to you, and we can answer any questions what the participants have.
Yeah. Thank you, Ishan, for your very detailed the presentation in terms of the methodologies to use and any particular methodologies, and also comparing each methodology as well as the knowledge and skills required. That's absolutely very important area. Particularly, we use a lot of analytics, particularly on the lot of data based on the forecasted cash flows, forecasted information. So, very important, and importantly, the heading is just common sense to make sure that you arrive at the right and appropriate value based on your valuations, and we're taking out to us on the challenges as well. So let me pose questions to you. Thank you very much, Nishan, for taking us through and detailed presentations. First question is that on the implication on the current economic situation on a valuation of a business, of a valuation of entity. As we all know, current discount rate or risk-free rate is over 22-23% now. So, we do what is called a risk-adjusted, and risk premium is added to the risk-free rate. And, so very discount rate as a result can be high as well. In addition, and forecasting right cash flow, so the income and expenses will be very challenging under present scenario, because we don't know what's going to be the cost tomorrow and day after. Things are changing, highly volatile environment now. So in that, considering all of those, what do you think about specific focus area that when we do evaluations, what are the areas that we should be very careful, should we pay attention to when you're doing evaluation, considering the present economic circumstances happening now?
Okay, so these days, actually, if you look at the stock market is depressed, and in most stocks are trading less than the asset value. So when it comes to valuations under these circumstances, now a valuation is not a short-term thing, unless if you are doing a valuation for a, say, a 2 to 3 year treasury bond or something like that. An equity valuation is a perpetuity and a long-term thing. So you need to see how this is going to apply over the long term. That is why I said, now when you are building the model, you need to have the, as far as possible, you need to go into the minute levels in incorporating variables. Then you will have to see each variable, what is going to happen, right? So in that hotel example, if you take the room rates nowadays, okay, you find it extremely difficult even to sell a room for $50. Okay, but will that situation remain forever? Right? So what can we reasonably assume? Okay, so okay, this situation, I can't say, as a final conclusion, but okay, let us say this situation is going to continue for 3 years, right? So for those, so next 3 years, current year plus another 2 years, our room rates might be at a very low rate. If you think that, okay, for another 2 to 3 years, the tourist industry won't recover, right? The occupancy rates will be much lower, right? Similarly, you might have your cost management strategies, which might bring down some of your costs also. And your growth rates over the next couple of years may be very moderate, or maybe a negative growth, if at all. However, after that, what is going to happen? Okay, maybe in the 4th year, you consider, okay, now, for example, if you take our exchange rate forecasts, we take it now as 360 or something like that. Maybe for the next year, we might forecast, okay, it could be 400. But will it increase like that? I mean, 360 to 400 is about a 10% increase, right? So will it be 400, then 440, then 485, then 550? Will it go like that? Then that means in another 6 to 7 years time, it will be 1,000 rupees. It might not happen, right? So maybe you would be aggressive a little bit for the next 2 to 3 years, but then your forecasts may have to be toned down and have some moderate forecasts. Okay, but it would be a challenge. You will be taking certain risks. Okay, and you always know that when it comes to the DCF method, your immediate 3 to 4 years will have a huge impact on your valuation rather than the cash flows which are going to be there in, say, year 5 to 10. So therefore, when you build in those risks and the challenges into the first 2 to 3 years, that it itself will have a big impact on the initial value in the valuation. So that might answer our question.
Thank you, Sean. So there are a few more questions. Next is that what is the most appropriate valuation method? Is it asset-based or income-based valuation model?
I would say income-based, because an investor is always looking at returns on the investment. So only income-based will give you the returns, right? However, the asset-based valuation also needs to be in line with it. In certain industries, I would say that you can compare the DCF value and asset value, or income-based value and the asset value. For example, for a service organization, for example, if I value, if we want to value KPMG, for example, I mean your value, your cash flow based value will be nowhere near the asset value, right? One thing, you are not valuing your human resources, like value of charmer and all that, and you will not have I mean, a service organization does not have a large asset base. But on the other hand, I mean, if you take a standard manufacturing company, for example, you have a capital base and you need a reasonable return on that capital base. And if you take, for example, a property development company, then that type of an entity needs to have a reasonable return, and the standard on investment property allows you to bring in even the property value enhancements into the P&L, even though it is not a cash flow. So, so in some way, you can do some kind of a matching between the return and the value of the assets. So, when you say appropriate method, it depends on the circumstances, but even in such a circumstance, if the asset value is very high, but if it is not generating sufficient returns in terms of earnings returns or in terms of capital value appreciation, then there's something wrong in that asset value. That is what I was trying to say, right? So you'll have to relook at the asset value in that case.
So next
But
question
it is
is,
circumstantial.
yeah. Yeah, Nishan, the next question is, what is a valid period for a valuation report?
Of course, these days it is very difficult. I mean, I have some personal experience that we were reluctant to give even a 6 months validation period because discount rates are changing. I mean, overnight. But under reasonably stable conditions, I would say about 6 months, but these days I would say not more than 3 months.
Okay. Next is that, are there any acceptable education qualification or qualifications in valuation generally recognized in Sri Lanka?
Well, this is only a perception. In Sri Lanka, people think, okay, CFAs are the best to do a valuation. That is because our chartered accountants are not showing well that they can also do valuations. Okay. I mean, there is no regulation or anything as to who can do a valuation and who is competent of doing a valuation. I mean, if you take, I mean, even with all these competition, still, if you look at valuation reports which are publicly available, majority, I would say more than 75% are done by audit firms, right? So which means they are being done by chartered accountants. Of course, those relevant departments might have people with other qualifications as well. But still, I mean, overall, practicing firms are doing it. So therefore, it is only a perception because I think we are not marketing ourselves. We are marketing ourselves as tax specialists and audit specialists. So for other business areas, I don't think we are marketing adequately.
Next is that, thanks, Lance. The next question is that out of audit, is asking audit fee or valuation charge, which is higher. So he's asking which one, whether the audit fee is high or the valuation fee is high.
Okay. Again, okay. Now, if you take an audit is a long-term thing. Once you are appointed as an auditor, you will be there at least for about 5 years unless there's some significant circumstance which requires the removal of the auditor or change of the auditor. So therefore, when you are determining your audit fee, you are looking at next 5 to 10 years, right? The relationship with the auditor. And then when you are the auditor, there may be so many other benefits also that are coming. I mean, wherever there is no conflict, you can do certain other assignments, other services with that client. But when you do a valuation, that is a one-off assignment. So, I mean, when you are comparing audit fees and a valuation, are you going to compare the audit fees for 1 year with valuation fee? If you compare that, probably valuation fee may be higher because a valuation has a higher level of risk and public responsibility. For example, if you are doing a valuation for a listed company in relation to the fair value proposition of a minority shareholder, let us say, in a mandatory offer or something like that. That kind of a valuation, I mean, has a large degree of very high degree of risk and responsibility. So basically, you might want to charge a premium for that. So sometimes, I mean, but that doesn't mean, okay, there may be a very complicated client, a large conglomerate, single entity, or rather we'll take a conglomerate. Okay, for the group audit, you might charge about say 5 million rupees as the audit fee, right? And for the purpose of valuing the holding company, you need to value all the subsidiaries and apply SOTP. Okay. You might need more than 5 million for the valuation. It all depends. I mean, what kind of workload that would be there, and to what extent you will have a risk and responsibility.
Thank you. Next is that how we value the international brand, particularly asking the brand valuations. How could we do that?
Brand valuations, basically, there are specific methods like royalty relief method. So you need to apply certain parameters or certain multiples based on international databases and apply one of those methods. Most popular in Sri Lanka is royalty relief method. So you can value a brand based on that.
Now, the next question is that due to the current, due to the present significant devaluation of currency and inflation in the country, how that particular significant inflation and the currency devaluation, how that impact to a valuation assumption of 1 to 5 years. I mean, particularly what was done in the past as well. So now that impact, how that particular currency devaluation and inflation impact to the value assumption for 1 to 5 years, and what was done in prior periods as well.
The second part of the question is not clear to me.
Yeah, it's actually it's not clear. I think what he's trying to say is that if you have done a valuation in the past,
okay.
Yeah, but theoretically you had to basically reevaluate the whole assumption. Yeah, Manishan, yeah.
Right. Yeah. So maybe he may be raising the question, say in relation to a value in use calculation. We normally face this issue these days. Okay, last year value in use calculation was done based on certain assumptions by predicting the future cash flows. But okay, now we have actually come to year 2, and year 2 actuals are way different from what we predicted last year. So in that kind of situations, we need to readjust those valuations, and also discount rates may have to be adjusted. So we have to make it current. We need to do current valuation, but that doesn't mean, okay, let us say last year you did a valuation. We'll forget about impairment, but for a market transaction, you did a valuation using the macroeconomic situation at that point in the country, and the assumptions were appropriately made, judgments were appropriately exercised, and you got a valuation, and the transaction happened in at that valuation. And now after 1 year, you will find, okay, discount rate has increased from risk-free rate has increased from 10 to 20, and exchange rate rupee has depreciated from 200 to 360, right? And as a result, there is a significant difference in the valuation. But then the buyer cannot say, okay, I bought this and now I am making a loss, and you, the valuer, need to compensate me. That won't hold good as long as you have you can justify based on the circumstances. At that point, you have done your valuations. But in the case of impairments, if you have a situation like that, of course, okay, last year you could justify your brand value, the goodwill value, and CGU values and all that. But now, if the values have come down, then you might need a impairment write down in the current year.
Yeah. Then the last question, Nishani, is that the auditors are governed by many laws and standards, but the valuers are free of all, so they don't have standards or the laws to govern. That's what he's saying. And valuation is a high profitable. Is it you take as a valuation as a high profitable job? So that's the question. So with the governing standards and the laws.
I am not too sure whether it is high profitable because you know, Chamara, to what extent clients are negotiating now and bargaining. So I don't think it is high profitable because we have to be very, very competitive, and you can't say it is at premium pricing. No, it has to be very, very competitive.
Well, last question is what is the right time to do evaluation? What is the best period for evaluation? I'm not sure what the question is very clear. What is the best time period for evaluation?
If he is asking about the frequency of valuations for evaluation purposes, I think standard basically says 3 to 5 years. But otherwise, it depends on the purpose of the valuation.
Yeah, exactly. If for impairment purpose, it has to be done annually.
Exactly.
Yeah, so it's the common purpose, exactly. So that's all, Nishan, for all the questions. I think thank you very much for taking us through on your presentation. It was very valuable sessions, and thank you for answering all the questions as well. So I thank all participants for joining with us, and hope you have a very knowledgeable sessions. Nishan Fernando taken us through on the valuation practice. So we look forward to see you in the next sessions as well. We have active participation. So thank you and have a good evening.
Thank you very much, Chamara.